Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Kevin Mahn. He's the Chief Investment Officer with Hennion and Walsh Asset Management. And my question to Kevin is this potential recession different from other times in history? And Kevin, I'm sure you hear this question all the time. Is it like it was in prior periods? But let's start with inflation. The pressure's still there. Are we starting to see some relief?
We're starting to see some relief. Let's remember that in June, we learned that headline CPI was 9.1% on a year-over-year basis. However, that was prior to all the reductions in certain commodity prices that we've seen in July this far. Lumber is down 58%. Wheat is down over 24%. Natural gas is down over 30%. And most important to everyone, oil is down over 14%. So inflationary pressures are going to continue, but it does seem like they're starting to slightly moderate.
What are your thoughts on a recession? Are we in one already?
I believe shortly we're going to find out, Jill, that we've met the technical definition of a recession, that meaning 2 consecutive quarters of negative real GDP growth. We saw in the first quarter, we contracted by 1.6%, and as the estimates stand right now from GDP Now, we're expected to contract by another 2% in the second quarter. We also know that we have an inverted yield curve, and an inverted yield curve has predated every recession in our country going back to 1955. So the question then becomes, how deep and for how long does this recession last? And a lot of that depends on what the Federal Reserve does or doesn't do.
And I'm going to ask you that in just a moment here, but it's so confusing almost because employment is doing very well. Consumers are still spending. They might be dialing a bit, but they're still spending. So it doesn't feel like what we had in 08, 09.
It certainly doesn't. We have unemployment at 3.6%. We have the consumers continuing to spend. We saw a positive retail sales number, but we're also starting to see some dents in that armor as well. As initial jobless claims today, 251,000, the 4th consecutive week of increases. We also see that Americans now are dipping into their savings. Personal savings is down to 4.4%, the lowest it's been since 2008. We remember what happened in 2008. And Americans are putting more and more in their credit cards to help stave off those inflated prices. So it does seem as though this time doesn't feel like a recession just yet. How much longer can that last?
So what does the Fed do with rates at this point?
I think a 75 basis point hike next week is all but baked in the cards. They don't meet in August. They come back in September, and then they're going to see that we're in a technical definition of recession. They're going to see continued earnings deterioration. I think they pivot and become less hawkish at that point in time, perhaps only raising by 50 basis points or even 25 basis points in September. They don't meet in October. They have 2 more meetings November, December, perhaps 1 more rate hike in November or December, and then we wait to see who wins the midterm elections and what does that mean for the market economy?
It's going to be an interesting second half. So, Kevin, where do investors go for growth potential?
One area that we like during economic slowdowns or even recessions is healthcare. Now, there's 2 ways investors can play healthcare, Jill. One is through large cap traditional pharmaceutical companies like a Merck or a Bristol Myers Squibb. Another way is through the smaller cap biotech companies. We'd like certain companies in that space that have drugs in the FDA approval pipeline and also have the potential to be acquired by these larger cap pharmaceutical companies that have excess cash sitting on their balance sheets that they've been storing all throughout COVID. We think that's the real opportunity for growth. So if you're looking for a little alpha opportunity, consider some of the smaller cap biotechs. But if you want a little bit more of a defensive stalwart, look to those large cap pharmaceuticals.
And what if your primary objective is income?
Oh, yeah. One area we really like in this environment, of course, municipal bonds. Yes, I work for Hennion and Walsh, and that is our bread and butter. But municipal bonds had one of its most difficult quarters in over 40 years in the first quarter, yet it remains one of the best performing asset classes year to date. We also know of the tremendous supply-demand imbalance that exists during the summer months for municipal bonds. So we think that creates more upside potential, especially for high net worth individuals in high tax bracket. That tax-free income becomes very appealing to them. And then if you're not necessarily in a high tax bracket, but you're looking for some good income, look at preferred securities. Majority of them are issued by banks. Banks usually do well in periods of rising interest rates, such as the one we're in right now.
All right, Kevin, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.